Across the street is a property that's renting for $2,200 a month, piece of shit property, 2-bedroom, 2-bath. And then there's a big storage lot across the street as well. It's just being used for like gravel storage. It's not even that nice. And they have bases for lease. I got phone numbers. They're actually trying to sell that land, and it's undeveloped, just gravel. And so I'm like, interesting. It's got an old FSBO sign in the front yard. You can barely read the lettering on it. So I don't think the Hard Rock is taking that on the south side. This is still Orient Road on the south side of the highway. The north side is where the casino is. South side's kind of the front door. Further south is the jail. There's an elementary school down here nearby us. Still some residential stuff. Yeah, Hard Rock is not
only in the south. Only in the south. Would you have a sentence that starts with vacant land, elementary school, church, prison, casino on the same street?
Yes.
Like that does not happen in anywhere else in the country except the Southeast.
Our zoning laws are hilarious. And I mean, have you seen
Florida for you?
Have you seen the Theo Vaughn skit where he's like, the zoning there is crazy. You go to the chiropractor, get a prosthetic limb, and get like a massage at the place next door. It's like nothing makes sense. Get tacos and get your prosthetic limb at the same time. Just stupid stuff.
I tell you, man, when I had my big portfolio, it was all that kind of triangle between Charlotte, North Carolina, Spartanburg, and Greenville, South Carolina, and a little bit into northern Georgia. And I swore I would never buy another property in the Southeast.
Yeah, it's insane. You got to navigate. Like, there's money to be made there. You just got to know where it is and just kind of like be okay with your property being where it's at.
Yeah.
So you got to just find the deals, though. That's when we first looked at this deal, we were like, But then we ran it with the seller financing. We were like,
yeah.
Well, if we can get it at this price, I think it's a steal. So,
so let's go with the plan of renting it for a couple of years. What's the cash flow coming in at that?
In 3 years,
6,000 something in cash flow.
6,000 a month.
That's gross, and yes, per month. I think it's like actually
at the end of 3 years, we'll be around 133,000 with rent escalations.
And what's your syndication documents look like? Is there a pref to the investors? Is it just monthly cash flow? Like, what's that look like?
We haven't prepped them yet. I have the guy Seth Bradley is his name. He's willing to do them for $8K, and we're gonna do a 8% pref with 13% catch up to total of 13%. So 5% catch up. The difference there year over year on the exit.
So you're really only just paying 13% total,
and we're capping it. Like, if we make more, wonderful. But that's on them.
Deal. I couldn't sell that deal.
I have gotten, I think, $220,000 raised right now just from my first friends and family, because it's essentially just debt disguised as a syndication. You're smart enough to see that, and so are some of the other guys. They're like, I want the deal, I just want part of the upside. I'm like, this is such a safe deal, such little construction risk, that we would rather structure this as a debt position. But we're wanting to get our feet wet in the syndications. We know that this is better run this way.
Why don't you, instead of like doing the complicated math, why don't you just say, I'll give you 12% after whatever, then you could actually structure it as a simple debt.
Well, the main problem right now is to do that amount, we need a couple of years worth of being able to catch up those leases so the cash flow can match that, because we will do that clawback period where we can just pay them and start doing that. But for those first couple of years, we want to make sure our cash flow's there to make sure we're running, paying our main note, and at least getting them their 8%. And then on top of that, once we know we're all covered and we can get those first leases, like the first one's the church, and you saw their price per square foot, just absolutely horrendous. Once we're able to push them up or get them out and get someone else in, that just automatically increases our cash flow for those properties to the point where it's like, okay, we're sitting good now. We can keep going forward with it.
Yeah, if we could structure the debt position where it's 8% for the first 2-3 years and then 12% plus whatever catch up on the back end to make it 12%, that'd be great, because again, we need that cash flow in the front end to make sure that we're just protected.
So you're borrowing enough money, you're basically raising enough capital to pay for that floated debt.
Bingo.
Okay. Yeah. And you've got, because I couldn't sell that deal. Our investors, when we're doing condo.
You're looking at the man right here. You're looking at Seth.
All right, cool.
He can finagle anybody into. Yep. And honestly, how I look at it more or less is, yes, but you're also dealing with a lot larger of deals right now. We're kind of starter, and you're more or less, I'm not saying maturity, but you're at a more growth experience level. And I think people look at 13% right now, and they look at that number, and in their head, they're like, yeah,
good.
And if I could speak to that,
I think about it this way. I look at it like it's a bond. It's like going and buying an Apple bond, and instead of getting your current yield of 3%, you're getting 13%, and you know that it's in a secure investment. This isn't like I don't look at this as a risky investment. We're not having to do any construction on it. We know what we're purchasing it for. We know what it's going to cash flow at.
yep. And
There's minimal. I won't say there's not risk. There's always risk, but I don't look at it and say there's another deal that we're working at, and there's just a lot of construction numbers at it, and I'm just like, there's a lot of variables here, and that one's going to look risky, but this one I don't. It's more or less I look at it as a bond, and it's you're getting a great rate on it.
That's definitely how I would look at this. The idea of super low risk, super tested investors. Everybody's happy. There's basically, I mean, I'll bet you could sell it at 12.